Welcome everyone to another video on accounting. We are continuing to discuss adjusting entries. So there are four types of adjusting entries: prepaid expenses, accrued expenses, unearned revenue, and depreciation. Um, this is our fourth video on adjusting entries. In our first video, we talked about the reasons for adjusting entries. So, just to as a summary, the reasons for adjusting entries are to report the correct amounts of assets, liabilities, and owner equity. In our second video, we talked about what prepaid expenses are and how to do the accounting for them. In our third video was about accrued expenses. Again, what we discussed what they are and how to do the accounting for them. I encourage you to watch those videos so that you have more background on adjusting entries. In today's video, we are going to talk about unearned revenue. Now, this line represents the life of a business. The life of a business is divided into periods, and we call those accounting periods. So you have accounting period 1, 2, 3, and on and on. Each period is 1 year long, and management or a business keeps track of whatever happens in the business for that period and then prepares financial statement at the end of the period. Now, management prepares financial statement more regularly. So it divides that 1 year accounting period into smaller periods of months. So it will divide counting period 1 into 12 months, smaller periods, and it will keep track of whatever happens in the business for that smaller period. For, say, for example, January and then February and so on. Each of those months will be separate accounting period. Keep that in mind. So let's look at what unearned revenue is. Now, unearned revenue is when cash is received in one accounting period. So a business gets cash in one accounting period, say in the month of January, but products or services are provided to customer in the future period. So you can see that the insurance service is provided in period number 2, products are provided in period number 2, say in the month of January. So that means the cash is received now as of or in the current period, but products or services are delivered to the customer in the future. This is unearned revenue. So for us, the important thing is to know how to do the accounting for unearned revenue. So since a business receives cash now in the current period, now business will debit cash. Now for this cash it has received, the business has an obligation to deliver services or products to the customer in another period in the future. Now this makes it a liability. This obligation is to provide products or services to the customer is called a liability in accounting. Now, since we are going to be selling something to the customer in the future, that makes it our revenue. But since we have not sold anything to the customer of the time when we receive the cash, this revenue is unearned, and we will credit the unearned revenue account, and it's an obligation, it's a liability for the business. Now, when the business provides the product to the customer or delivers the service to the customer in the future, that's when the business has earned that revenue. So it will credit revenue. And now that the business has provided a service or product to the customer, it no longer has obligation to the customer. So that obligation of unearned revenue now is going to decrease and finish. So we are going to debit unearned revenue. So to give you one more example, say that you give me $100 to paint your apartment. Now, when I get this $100, I'm going to debit $100 cash. And for this $100, I have an obligation to provide you painting service in the future. So this obligation becomes a liability for me, and we call this unearned revenue. So I'm going to credit it. When I paint your house, when I deliver your services to you, the painting services to you, I have earned this $100 as revenue. So I'm going to credit revenue. And now I no longer have an obligation to you, so I will debit unearned revenue. Now there are the second one obviously is an adjusting entry, and there are many examples in the business for unearned revenue, customers deposits, membership subscriptions. For example, if when Amazon gets money for Prime membership from customers, it treats that as unearned revenue. Airlines, when they get cash from you from customers for flights to be delivered in the future, they treat that as unearned revenue. We'll look at a few examples ourselves. So first example is insurance. So on January 1st, ABC Limited received $1,800 to provide vehicle insurance service to customer for 3 months. So for the month of February, March, and April, ABC Limited has to provide insurance service to this customer, or insurance coverage to the customer. So the question for us is that what will be ABC Limited's journal entry for cash receipt? Similarly, what will be the entry in each of these months when ABC Limited provides insurance service to them? So let's look at the entries. So when ABC Limited receives the cash from the customer on January 1st, it is going to debit cash, obviously. Now for this cash, ABC has an obligation to provide insurance service to the customer for the month of February, March, and April. So this obligation is a liability, and we call this unearned revenue. So we will credit that as unearned revenue. Now I'm going to show you how this works in a T account. So if you look at the top right corner, you will see the unearned revenue account with $1,800 on the credit side, and a balance of $1,800 is there. Now at the end of February, um, ABC Limited has now provided the service to the customer. So it has earned some revenue by providing this service to the customer. Since $1,800 was received, that means ABC Limited earned $600 of revenue in the month of February. So it will credit revenue by for $600. Now, ABC Limited has now 1 month less obligation to this customer to provide the insurance service. So this obligation is known as the unearned revenue, and it decreased. So we are going to debit unearned revenue. So you can look at the T account in the top corner to see that a debit on the unearned revenue account, bringing the balance to $1,200. So now ABC Limited has only $1,200 of obligation to provide service to the customer. So at the end of March, a similar thing will happen. Now that ABC Limited provide the service to the customer, it has earned that as revenue, so it will credit that revenue $600. Again, ABC Limited has 1 month less obligation to the customer, so that obligation is the unearned revenue. We will debit that unearned revenue. Looking at the T accounts in the corner of the video, you can see that for March, it is debited, bringing the balance to $600, which means ABC has now $600 of obligation to the customer. At the end of April, the same entries will repeat. So we will credit service revenue $600, and now and debit the unearned revenue $600. And now you can see in the T accounts for the month of April, $600 is recorded. So now the credit sides and the debit sides equal the same amount, bringing the balance to zero. So ABC Limited has now fulfilled the obligation, and it has no more obligation to the customer. Obviously, ABC Limited is in the business of providing insurance to customers. So this cycle will repeat, and the accountant at ABC will do these entries again and again. Let's look at one more example that is about rent. So again, on January 1st, ABC Limited received $3,000 from a customer as rent for 3 months starting January. So the office space will be provided by ABC Limited to a customer for 3 months starting in January. So it will be provided in January, February, and March. Now the question again remains, what will be the journal entry ABC will make for the cash receipt on January 1st? And at the end of each month, what will be the journal entry that ABC Limited is going to make? So when it receives cash, obviously it is going to debit cash. And for this cash, ABC has now an obligation to make available the office space to the customer. In the future, this obligation is known as unearned revenue, and we are going to credit that unearned revenue. Again, if you look at the T account, you can see that unearned revenue is $3,000. And the balance is $3,000 in this. That means ABC Limited has an obligation to provide $3,000 of worth of services to the customer. Now, at the end of January, ABC Limited has made available 1 month of office space, so it has delivered the service. That means it has earned the revenue. It will credit revenue. And now, at the end of the first month, ABC Limited has 1 month less of the obligation to the customer to provide a service. So that means the unearned revenue account will be debited by $1,000. Since it's $3,000 for 3 months, that means $1,000 for a month. Looking at the T account in the corner, you can see $1,000 on the debit side of the unearned revenue. Now that brings you the balance to $2,000 in unearned revenue, which means again ABC Limited has $2,000 of obligation to the customer to provide or to make available the office space to the customer. At the end of the February, same thing will happen. ABC Limited has now provided the service, so it will record that as revenue $1,000. And again, ABC Limited has 1 month less obligation to the customer, so it will debit unearned revenue $1,000. In the T account will be updated by $1,000 on the debit side, bringing the balance in that account to $1,000, which means ABC Limited has $1,000 of obligation to the customer now. Finally, in the month of March, same process, ABC Limited will credit service revenue because it has made available the office space to the customer, delivered the service to the customer, so credit revenue. And again, ABC Limited has 1 month less obligation to the customer, so it will debit unearned revenue. To update the T accounts, you can see that $1,000 is updated on the debit side of the unearned revenue because the unearned revenue account is debited, bringing you the balance zero, which means ABC Limited has delivered the or settled the obligation. No more obligation to the customer. Of course, ABC Limited is in the business of renting out its premises. So the cycle will repeat, and the accountant at this business will continue to do the same thing. So, just to give you a review, adjusting entries, we talked about unearned revenue. So, you need to understand that there are journal entries at the time of cash receipt and at the time when the product or service is delivered. So, when the cash is received, the business debits cash and credits unearned revenue for an obligation to provide a product or service in the future. So when it does provide the product or service to the customer, we are going to credit our revenue, be sales revenue or service revenue, and that will decrease our obligation to the customer, which means we are going to debit unearned revenue. That was about earned revenue. Hopefully the video was helpful. Watch it again if you did not understand any part of it. And remember to like, subscribe, and click the notification icon so that you can see you will be notified about our future videos. In our final video, we will talk about depreciation expense, so do watch that as well. And I will see you in the next video.